Stocks come under pressure as the rupee slips with declines far outpacing advances. Metals, IT, financials and energy are the big drags, while telecom and FMCG eke out some gains.
The rupee breaches 91 to a dollar despite a lower than expected trade deficit in the month of November as unhedged importers rush to buy dollars. A delay in concluding a trade deal with the US and continued foreign investor selling continues to be a drag.
The Insurance Amendment Bill is set to usher in significant changes with moves to increase foreign investment to 100%, permit M&A with non-insurers, offering more investment flexibility and put the spotlight on commission and expenses and more.
NCLT is expected to pronounce its decision on Vedanta's demerger plan today. This follows the Ministry of Petroleum and Natural Gas raising objections, citing potential financial risks due to inadequate disclosures.
Hello, good afternoon. You have tuned into Halftime Report on CNBC-TV18. We're coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me are my colleagues Sona Butra as well as Ekta Batra. Good afternoon, ladies. And a day again that we're seeing some bit of pressure that's come in for the markets. Nifty is down almost 150 points in the trading session, but we're following what was happening in the US as well as the Asian markets as well. This morning opened up in the red. Now, obviously, we are seeing almost a 0.6% of decline that's come in for the Nifty 50. All the sectors except for Nifty FMCG are trading in the red. Nifty Metal obviously clearly seeing a bit more of a pressure. Realty and IT are also these other sectors which are down and out in trade. Nifty IT is down almost 1% and Bank, look at that. Nifty Bank is also down almost 0.7%. We're not seeing much of a support that's coming in for the markets. Advance decline ratio also clearly in the favor of declines versus advances as well. And rupee also is something that is almost at the lows.
Oh yes, that is the big talking point. Definitely 91 on the rupee. It has been a one-way slide. It just took 10 trading sessions for it to go from 90 to 91, and that's something, of course, we'll continue to address and analyze with Lata, with our experts as well, and that's something impacting the markets as well.
Yes, absolutely. I think that is the overarching sentiment negative for the markets, and as you can see that in today's trading session. But besides that, the rupee has fallen around 1% just in the last 5 trading sessions. So the intensity or the velocity of the fall or the depreciation from levels of around 89 to around 91 have been swift and rapid. But let's in fact address the biggest talking point for today, which is the rupee depreciation. We have Lata joining in. She's been working the phone. She's been working the phones to find out what exactly would the next steps be. Is the RBI stepping in? Why hasn't the RBI, in fact, stepped in enough? Lata, over to you.
Well, the reasons for the rupee's fall are known to all of us. It is this relentless FPI selling of equities, buying dollars and remitting it out of the country. That is not, it's not a mystery. It's known to everyone. It was just that one was expecting that the Reserve Bank will come in at some point. The Reserve Bank is probably having a hands-off approach, and that is further leading to a sentiment in the market that, you can short the rupee or you will have to come and hedge. That's exactly what we have seen today as an additional reason. The fact that the FPIs are exiting and that the trade deal is not in sight are negatives that have been with us for some time. What has added is that if you look at from November 15th to today, the rupee has fallen 3%. Until now, the importers are used to the rupee falling 3% in a year. So probably until November, when the rupee fall was about 2.5%, they were reconciled that this is what we normally see. This accelerated fall in the last 3 to 4 weeks, has got them napping. And you're seeing today at least several bankers telling us that importers are buying big time. So there is the FPI buying of dollars. In addition to it, there is some serious buying of dollars by importers as well. And at no point in time are we seeing any big support from the Reserve Bank. They're providing some sales. In fact, today there is the buy-sell swap as well, which they're doing, unrelated to dollar. That is more to provide liquidity to the market. They're not supporting the rupee with any seriousness or any level intent, and that's why you're continuing to see this fall in the rupee. No one has a level because all levels, they say, have been taken.
But what can RBI do, Lata? Is there anything that the market is watching out for? You're saying they're not doing anything yet, but is there something that can do?
No, the first step, of course, is to provide a load of dollars at a level and pretend that I am, send out the message that I'm not going to allow beyond 91 or some such, a cascading sale. Usually, central bankers desist from doing that because you will only be giving the FPIs a more lucrative exit. So, you want to see if there is serious, like for instance, Prudential, they will move out at any price because they are divesting. So when there is serious intent of leaving, the Reserve Bank doesn't come in the way and provide a lucrative, profitable exit to someone who is wanting to exit. But when they feel that it has reached the level of speculation, they will come in. When it reaches the level where it is starting to hurt Indian growth, like, people are not investing because we don't know what is the level. If there is a sense of instability, then they will come in. There are bigger, weapons they have during the taper tantrum time, and before that, during the nuclear testing time, they issued the Resurgent India bonds, the Millennium India bonds, which gave NRIs a very attractive interest rate. And so dollars came in. Clearly, the government doesn't think we have reached that level of having to come with a policy support or change taxation for FPIs. At the moment, they pay withholding tax. You remove that. There are umpteen arrows in their quiver. But at the moment, the Reserve Bank and the government, and in fact, the chief economic advisor even said it, the fall in the rupee will mean expensive imports. It will mean a rise in inflation, something we can take because our inflation is at 0.25% or 0.7%, the last number we saw. And crude is at $60. I mean, even if you multiply it by 90, it's not a very big deal. All of last year, you had $85 and you multiplied it by 85. So at the moment, the arithmetic is still not, serious as far as the macros are concerned. But at some point, when the Reserve Bank and the government jointly think that this is hurting the growth sentiment, I suspect they will come with all these arrows, depending on the seriousness.
Okay, all right, Lata. Thanks very much. Okay, we do have the Finance Minister talking in Parliament. Let's cut across.
Act 1956 and the Insurance Regulatory and Development Authority Act 1999.
Sri N.K. Premchandan.
Sir, I rise to oppose the introduction of the bill. The Sabka Bima Sabki Raksha Amendment of Insurance Laws Bills 2025.
All right, so that was the Finance Minister tabling the insurance bill. We'll do one thing. We'll take a short break on that note, but we do have an important voice coming up next. So let's get to that. An exclusive conversation with Neelkant Mishra of Axis Bank on the Indian markets in 2026. Stay tuned after a short break.
Welcome back. You're still tuned into Halftime Report. Let's go across to our special Outlook 2026 series. India had a Goldilocks 2025 with growth likely to be at 7.5% and inflation at 2%. And yet the rupee struggles and Indian stock indices were underperformers compared to US or North Asia. My colleague Lata Venkatesh caught up with Neelkant Mishra, who's the chief economist at Axis Bank, and began by asking their FY27 growth forecast of 7.5%. Listen in to a slice of that conversation.
Yeah, so I will start with what I've been repeating, and I'm quite surprised and shocked that economists can still see a stimulus in FY26. This fiscal year. See, the way I see the Indian economy is that in FY25 you had simultaneous fiscal and monetary tightening. The fiscal tightening was explicit 80 basis points, and on top of that, there was another 50 basis points where the government collected GST compensation cess, but was retiring some off-balance sheet debt. There was 130 basis points of fiscal consolidation in FY25, the last fiscal year. And on top of that, because of the letters sent to some of the large private banks, credit growth slowed very sharply. And that itself was equivalent to more than 2% of GDP worth of monetary tightening. So if credit growth slows, obviously GDP growth will slow as well. So the economy delivered 6.5% despite significant fiscal and monetary tightening. In FY26, I think, again, I'll reiterate, I've been saying this from budget day, that the tax cuts were not a fiscal stimulus. The government was still bringing down its fiscal deficit. That is simple macroeconomics, that 4.8 going to 4.4 means that the government is a drag on incremental demand, on aggregate demand. And therefore, the economy this year, till the time that the GST cuts happened, which actually kind of neutralized some of this tightening, the economy was still facing headwinds on the fiscal side. On the monetary side, at least, the incremental headwinds faded. So it's almost like, if it's like a maybe class 3 maths, that if an aircraft is on the ground speed is 700 kilometers an hour, and there are headwinds of 250 kilometers an hour, if the headwinds fade to 100 kilometers an hour, what will the aircraft fly at and on the ground? And that's exactly what has happened this year. So the growth surprise for many people was not something that was a surprise to us. We expected that as the headwinds ease, the trend growth will start showing up. FY27, the fiscal becomes even less of a drag. So this whole narrative that, the government doesn't have fiscal space has been true for the last 5 years. In fact, the pace of fiscal consolidation is now slowing. So now you have, we are forecasting 4.2, but let's see what the government throws up in the budget. So only 20 basis points versus the 40 basis points that happened in FY26. And the monetary, all the easing of conditions, the fact that there is now a firm vision or message from the central bank, I think credit growth is starting to revive. That can become a tailwind. So we can run the economy above trend for a while, and that is why we are at 7.5%.
Okay. Well, fair enough. Let me come to earnings. Time permitting, I'll get back to the macros of inflation, etc. later. But earnings has been our bugbear. Do you think we are going to get to high single digits or double digits? And what gives you that confidence?
So both macro and micro. So you have the 12-month forward earnings, which frankly is what matters. So you had a very nicely upward sloping curve, and then the last 12 months it has flatlined. Because whatever you gained from the roll forward, you gave up by the pace of cuts. So you're seeing like 3% plus cuts every quarter in index EPS. Our expectation is that as GDP growth stops disappointing, because many of these trend indicators were below what was expected in terms of momentum earlier, especially on large sectors like autos and financials. And so once this starts to revive, the pace of cuts will start to slow. And therefore, the 12-month forward earnings then resumes its upward climb. And our forecast published in the report is that the 12-month forward is likely to rise by about 14% in the calendar year CY26. And the second approach to that is to look at assumptions sector by sector. So there are 4 sectors which account for nearly 2/3 of index EPS, which is financials, IT, industrials, and energy. And in all these 4, the assumptions look reasonable. I don't want to bore you with all the details, but the gist is that the CY26, and therefore, and you're absolutely right, if the 12-month forward earnings start to climb, our weights in passive indices start to go up, our market either becomes cheaper or starts to climb, and then FII flows start coming back, and a lot of other factors then start to stabilize.
Welcome back. Well, the rupee has fallen to a fresh low versus the dollar. This fall is despite the fact that India's November trade deficit fell sharply as compared to the record deficit that we saw in the month of October. We have with us senior Forex expert K.N. Dey and Kanika Pastricha, who's the chief economic advisor at Union Bank of India, joining in. Mr. Dey as well as Kanika, thank you very much for taking the time out. Mr. Dey, I'm just going to come to you. It has been around a 5.5% depreciation that we've seen this year. for the rupee. And we have depreciated much more sharply as compared to, say, the Indonesian rupiah, the Filipino peso. What is your sense in terms of what the key pain point has been for the rupee depreciation, and where do you think we're possibly going to stabilize?
Hi, good afternoon. Well, as you rightly said, the last 6 months, rupee has almost depreciated by 5.5%, 6%, and the whole year is around 6.5%. And the first villain for this rupee depreciation is it started off when our U.S. president came in from January this year. It started talking about tariffs and putting negatives in the market, confusion. When we saw a lot of FIIs selling this year, if you see from January till December, I think FII's net inflow is minus $25 billion. And they have been selling almost every month except 2 or 3 months, maybe July, August, or maybe one more month. Otherwise, in every month, FIIs have been selling. And as of date, around 225,000 crore of rupees has been out from the Indian market, periodically, month-wise. That is one of the biggest negative for the rupee, where we didn't get any inflows in the equity markets. There was some FIIs money coming in the bond market, but the whole year was something around 8 billion till last month. I believe even that sell-off is started this month also. So there is no actually negative flows. That is the biggest thing for India. Then we have this tariff coming in, and about a couple of months back, and then this penalty, and then a lot of stories coming in the market. We are almost done with the tariff. Everything is done. We will be here, there. But still today, nothing is happening on the tariff. No. And I believe even if tomorrow U.S. reverses the tariff from 50% to even 20 or 25 or 15, whatever it is, I don't feel the rupee would correct back. Because it may be little half 1%, but not to those old levels. I think 88, 89 are history as now. Oh. So going forward, that's all history now for me. It looks like that. Because, again, why will RBI has been intervening? They have no fixed rate in the mind at what rate it's depending upon the market-driven rate. They are only trying as a speed breaker to intervene and stop the speed. And today we saw a lifetime high of 91 point, I think, 0708. And this would continue. And being a year-end also coming in, and normally in year-end the markets become thin as we go forward. And any thin market, any demand coming in, the volatility also goes high. So this thing will continue for some time, and maybe we could see some stability coming in from the second half of January coming here, where we might see some flows coming in, provided there are some positive things from our side.
Okay, all right. So you do not see it getting back below those 90 levels anytime soon. Kanika, Mr. Dey also mentioned what the RBI is doing. It's not a big policy change or intervention that's coming in from the RBI, right? Do you think it is done? Because what's your sense first up? Should RBI do something? If yes, what would they be doing? Or is it a fact that this is basically motivating more exports, helping exporters, and this is something that the RBI wants to continue?
So, first of all, thanks a lot for having me on the show. 2 weeks back, rupee was about to hit 90, and I was on the same show. Now, in just 2 weeks, we are pulling towards 91 handle. See, it's December. Liquidity is low. FPIs are selling, and as you rightly said, Ekta started the show by stating that fundamentally nothing much has changed in the last 2 weeks. In fact, we've only got a positive data from a fundamental perspective, where trade deficit has narrowed from $41.5 billion to $24.5 billion. So from that perspective, what becomes very important is that rupee fundamentally is unlikely to be at these levels. Overshooting typically happens in December. And the reason for that is low liquidity and the sentiment that's taken a downbeat because of delay in US-India trade deal. Now, last time also I had stated this, on a 3-year basis, when we look at a fundamental handle on the currency, it typically depreciates by 3.5% annual average. And on a 3-year basis, that's respected. 2020 to 23, March 22 to 23, rupee depreciated by close to 9%, 3% annual average. Now from 2023 till 25 March, rupee was down by 4.5. So this year we were already forecasting rupee moving towards 89.90. Moves beyond 90 is overshooting in our view. It's in a zone where in December, typically such moves happen. RBI is there, always there, compliments to them to handle volatility in the currency. Levels very difficult to predict at this juncture, but we think eventually by March, currency likely to settle back to fundamentally prudent levels, which we think is 90 or below.
Okay, you think 90 or below, maybe by March is what we'll keep an eye out on. Mr. Day, just a quick word. So you said that FAII selling, obviously a big concern coming in there, and this is not coming into the equity markets. Do you think if FII start coming back or valuations in the equity market come lower, that's when we'll see the buying coming in, and that's when the rupee will settle further?
Absolutely, because once you create a confidence, something on the FIs where they will start coming back in the equity market, obviously the rupee will go. And obviously then whatever RBI has intervened for last couple of months, they will try to recover the dollars they have sold in. And we had, I think, reserve about $704 or $5 billion a few months back, which has come down. So I personally feel I want the FIs to come back to invest in India. And once they come back, we will, I think RBI may parity the rupee as my other colleague told. Should be around 90 here or there, because we also cannot make the currency too strong enough to support our exporters. At the same time, make it not very volatile to see that it hurts it has to be balanced in a proper way. So I guess, as you said, maybe 90, around 90s, maybe somewhere there, the rupee should stabilize going forward. Hopefully, the FII starts coming back. As I said earlier also, I don't think the tariff would make a very big difference now, because most of the, except I think the textile exporters have been hit very badly, but I guess they are now readdressing their issues. So I think we need to have some positive things coming out to lure our FIIs to come back to India to put in the money as fast as possible.
Sure. Okay, Mr. Day, as well as Kanika, we've completely run out of time, but the topic does continue as the biggest topic for today's trading session, and not only today, but in the past couple of days. We need to take a short break with the news that the insurance bill has been tabled in the Lok Sabha, and the details of that is flashing on your screen in terms of what the finance minister is saying at this point in time. We'll take a short break. Manisha Gupta will join in next. She has with her David Tate of the World Gold Council. Stay tuned.
Welcome back to our halftime report on CNBC-TV18. As of now, Nifty is down 140 points, around 25,880 levels is what the Nifty is trading at. Slight bit of a decline is what we're seeing in the last few minutes of trade as well. The broader end of the market, that also continues to be under pressure. Nifty mid-cap is down almost 0.8% in today's trading session, as well as the small cap too is trading with cuts of almost 0.7%. IT2 under pressure, and apart from that, we're seeing FMCG, that's the only one which is managing to hold on to green. A lot of individual movers today, especially we're seeing Policy Bazaar that's down and out. Ola Electric that's seeing a pressure and a fall of almost 4%. Axis Bank too seeing pressure and down almost 3 to 4% in today's trading session. We'll keep an eye out on those names as well. And apart from that, these food delivery names, Eternal, Swiggy, both of them are also under pressure. So keep an eye out on that as well. On that note, we're going to slip into a very short break. After the break, we'll come back and we'll talk more on commodities. Manisha will take us through a conversation on that.
Welcome back, and joining us on the show now is David Tate. He's CEO of World Gold Council. David, hi, thank you so much for joining in. And you are in India, and I'm hoping you're having a good time here. And when you look at the gold prices then, and they have had a stupendous year as well, the best year since 1979. How have you seen the year 2025 in sense of prices and sense of demand as well?
Well, I've been very, very happy with the price rise over the course of the last year, as you would expect, given my role. It has been somewhat spectacular, even by our estimations, I have to say. Over the course of the year, we've obviously seen continued central bank buying. We've seen all the major buyers that you would expect get involved in gold. We've had some notable events. We've had deregulation in China, which has made a big difference. We've seen a huge growth in ETFs in India, and which I expect to increase over the forthcoming years. You've had Japan has adopted gold in a major way over the course of this last year, which we expect to continue as well. I mean, quite frankly, they're suddenly discovering what inflation is after 30 years and a little bit of geopolitical risk. So I expect to see great things happen in Japan. And then, of course, the old classics, shall we say, the normal economic stuff that we've grown to know and love over the year has supported gold. Then we've got the interest rates and dollar, which have all done their part. But most importantly, we've had a never-ending burden of ever-increasing debt. So whichever way I look at it, there are a whole variety of things which are continuing, which have supported gold over 2025. And frankly, I don't see changing going into 2026 at this moment. I do think there is one scenario, though, which could change everything, but I'll leave that one for later.
No, that's coming up exactly the second question as. So what do you feel? I mean, is it safe to say that the gold prices will continue to make higher highs because most banks and brokerages believe that we are headed towards 4,500 and 48 and 5,000, also a possibility in 2026. You're saying that there is perhaps going to be a reason that we will not see those numbers there. What is it according to you?
Well, actually, no. I have 6 or 7 main reasons why I think it will continue higher. That's probably the way I should couch it. I'm firmly of the belief that it will go higher for those 6 or 7 reasons. But I can see one situation where I think it could, people could start to view gold differently, but that's probability adjusted, very low probability. And that is if the United States, for instance, Mr. Trump, gets very lucky, manages to spur 6-7% growth in the United States with moderate inflation, and is able to project a declining sovereign debt level. At the moment, we know it's $37 trillion, and he's doing his best to force down interest rates to generate enormous amounts of growth. I think that's the game plan. And if he is able to suddenly project that in 2030, 2032, the overall debt burden of the country will start declining, that will probably give a number of people who have been convinced that buying gold is the right thing to be doing because of currency debasement, because of the threat of runaway debt burden. I think that is a scenario that could start to raise a few doubts in people's minds about the future of the gold rally. But I must stress, I think that's an incredibly low probability for him to be able to pull that off. Okay. It's the only scenario I can imagine that will probably put a dent in gold's rally. And like I said, I think there's 6 or 7 major contributors to why it's going to go higher. And some people are talking incredibly high numbers for gold, and I would not be surprised.
David, let's talk about the investment part as well. And we've spoken about ETFs, but there has been a lot of retail investment and physical investment as well that we've seen, especially in India and other parts of the world as well. This also is going to be one year when the investment is perhaps at very, very high numbers. How are you looking at retail investment going forward for the Indians? Because of the rupee depreciation, the gains are even more sweeter there. But how are you looking at overall investment globally? And second, how do you look at gold buying in sense of India as an impact?
Yes, we've seen over the world the desire to invest in gold is somewhat different from the jewelry market. The jewelry market has obviously taken a hit because of the increase in price, and that's to be expected. But that jewelry market also is very durable. It does come back once the price sidelines for a little while. And frankly, just above $4,000 it has done. And the jewelers I spoke to en masse yesterday, they were seeing relatively good pickup in their showrooms. However, it is the investment bar and coin from a physical perspective and the ETF world that has seen the major increases over the course of the last year, and I expect to continue going into next year for the reasons that I've largely mentioned. I think most people in the world are now very, very alive to the fact that the financial situation throughout the world from a debt perspective, as I said, is threatened. And there are not many prospects of that improving anytime soon. Many of the countries, at least in the West, are suffering from almost non-existent levels of growth, and yet ever higher burdens of debt. Take the UK as an example. It cannot seem to find a way to cut its own costs. That sort of scenario to the average investor lends itself to a threat to its currency of each of these current countries. It feels like the financial situation is failing. And that is a perfect scenario for people to get involved in gold. And so investment bars and coins I expect to continue to be very well in demand globally. Okay. But I would say probably the keenest opportunity for India will be the growth of the ETF market and gold funds. Because you've got a large younger generation coming into an awful lot of money, and learning about financial markets and gold in particular as an investment asset, coming from a very low base. And the opportunity they have is to not be frightened by the idea of an exchange-traded fund, which sounds awful grand, but is essentially a very simple tool. And I do believe having access to mobile phones and their willingness to experiment will mean that you'll see a whole generation start to invest and hold gold in this form going forward.
So, well, 25 has been a great year, and 26 perhaps would see a spillover of great demand. And of course, as you said, more awareness about financialization of gold in India as well. David, as always, thank you so much for joining in and making sense of what to expect from gold in the next year too. With that, go for a very short break, come back and talk more about markets.
Welcome back. Still tuned into Halftime Report. We are consolidating at the 25,900 mark. The mid-caps are underperforming, down 0.9%. Barring FMCG, all the indices are in the red today, so continues to be a down day. We'll keep tracking the market moves for you, the rupee depreciation and a lot more. There's so much happening in the markets today, so we'll take your leave for now, but stay tuned. Business lunch is up ahead to take all the action ahead.